The biggest lie you have ever been told is that Wall Street wants you to get rich. They don't. Most people who enter the market are what insiders call exit liquidity, a polished way of saying you're the person who buys the stock right before the billionaires sell it. You are the buyer they were waiting for, the last guy at the poker table who hasn't figured out he's the fish. I was 19 the first time I walked onto a trading floor. 1993, New York Stock Exchange. Still physical back then. Grown men in color-coded jackets screaming at each other, paper tickets flying, phones ringing like the building itself owed someone money. I was a runner, bottom in the food chain. My job was to carry trade orders from one post to another. I was furniture that could jog, and paid like it too. But here is what being furniture teaches you. Nobody watches the furniture. And because nobody watched me, I saw everything. I saw traders laughing 30 seconds before a stock crashed, not because they thought something was funny, because they already knew. The news that would send every retail investor into a full meltdown wouldn't hit the wire for another 4 minutes. On that floor, 4 minutes is a Porsche. 4 minutes is a beach house. 4 minutes is your kid's college tuition. Handled. That was the first thing Wall Street ever actually taught me. Not a chart pattern, not a strategy, a gap. The gap between when the powerful find something out and when you find out. Everything I'm telling you in the next 12 minutes lives inside that gap.
By 1999, I had fought my way into an actual seat, trading tech for a mid-sized fund. And I want to be honest, 1999 was the greatest party I have ever attended in my life. Companies with no revenue, no product, sometimes no office, were tripling on day one. My colleagues were buying Porsches like they were buying lunch. A dentist from New Jersey told me at a barbecue he was retiring early because of his Cisco position. Said it the way people say they found a great parking spot. Hold on to that, dentist. He comes back. What I was too young to see, the institutions had already started leaving, months before the crash. Quietly, no announcement. They just eased toward the exit the way you do when a house party starts feeling like it might become a situation. The problem is, you can't sell $1 billion of stock without the price collapsing mid-sale. You need buyers. You need 1 million dentists from New Jersey feeling like geniuses. The media coverage, the magazine covers, the "this time it's different" energy, all of it exists to manufacture one thing: liquidity for the exit. By the time the dentist bought, the hedge fund manager in Greenwich had already sold and was probably on a boat. The Nasdaq peaked in March 2000 and fell 78% over the next 2.5 years. The dentist did not retire early. I was at a dinner in December 1999. 3 of the most senior fund managers in New York. End of the greatest bull run any of us had ever seen. They barely touched their food. Quiet in a way that felt deliberate. I thought they were tired. They weren't tired. They were done. The move was already made. We were all just waiting for the rest of the world to find out. The most important weekend in modern financial history happened in September 2008, and the version you were told is missing about half the story. Lehman Brothers had been bleeding for months. The question wasn't if they needed a rescue, it was who would do it. 6 months earlier, Bear Stearns collapsed and the Fed ran a clean bailout through JP Morgan. Everyone assumed the same play ran for Lehman. They let Lehman die. The official explanation was that Lehman was too big to save, except Bear Stearns was also enormous, except 6 months later, AIG, even bigger, got saved with $85 billion of taxpayer money over a single weekend. So that explanation has a math problem. What Lehman's death actually created was fear, the specific kind that makes people stop asking questions and start signing whatever gets put in front of them. Within days, Congress approved the largest financial bailout in American history, $700 billion with almost no debate. The whole thing moved faster than most people's mortgage applications. Look at who was in that room. The Treasury Secretary, the Fed Chair, the heads of Goldman Sachs and Morgan Stanley. Look at where they came from, where they went afterward, and which firms were posting record profits by 2010, while millions of Americans lost their homes. I'm not telling you what to think. I'm telling you to notice who benefits from the panic. On Wall Street, nothing that size happens by accident. Crises get managed. The question is always, managed for whom?
By my late 30s, I'd survived 2 crashes and rebuilt twice. I thought I understood how the machine worked. Then I found out there was a second machine running underneath the first one. Around 2010, serious trading desks stopped talking about stocks and started talking about dark pools. Private exchanges, completely legal, completely invisible, where institutions moved massive blocks of shares without those transactions ever appearing on the open market. Right now, roughly 40% of all U.S. equity trading happens in these venues, not on the NYSE, not on NASDAQ, in the dark. Nearly half the trading in the market your 401k lives in happens somewhere you cannot see, cannot access, and would not know how to find. You open your app, stocks sitting flat. You assume nothing is happening. Meanwhile, an institution just quietly moved 4 million shares through a private exchange, and by the time the price moves on your screen, it's already done. You're watching the echo, not the event. Then the high-frequency trading firms arrived and made it worse. Companies that spent hundreds of millions, not on analysts, not on research, on fiber optic cables, specifically routed to place their servers physically closer to the exchange's computers, to shave microseconds off execution time, 1/1,000,000th of a second. They paid for data center real estate in New Jersey because being faster than you by an amount of time your brain cannot perceive was worth more than any analyst alive. When I found out about all of this, I had 2 choices: get angry about a game I couldn't win at that speed, or realize speed was never my edge to begin with. For 30 years, I kept a private journal, not of trades, of moments. Specifically, the moments the crowd was most wrong. The crowd isn't wrong all the time. It's right through most of the middle. It's only at the extremes, peak euphoria and bottom panic, where it becomes nearly perfectly incorrect. And those extremes follow a pattern that eventually stops feeling like market analysis and starts feeling like watching the same argument in your family every Thanksgiving. Same people, same escalation, different year. Late 2002, bottom of the dot-com collapse. Retail investors pulling money out at the fastest pace since 1987. Sentiment surveys at historic lows. Magazine covers declaring the death of stocks as a concept. The S&P 500 then tripled over the next 5 years. Early 2009, same surveys, same fear readings. Time magazine ran a cover about the end of capitalism. The market then went on the longest bull run in recorded history. March 2020, the Dow dropped 34% in 33 days, fastest crash ever recorded. Sentiment hit levels I had only seen twice in 30 years. Both previous times were the exact bottom. The market doesn't reflect the economy, it reflects human emotion, and human emotion runs in cycles that are embarrassingly predictable once you've watched them long enough. Institutions have entire departments measuring how scared retail investors are. They call it sentiment analysis. They call it contrarian positioning. I call it watching a crowd run toward the exit and quietly walking toward the door they just left open.
Most people know about the Federal Reserve, but fewer know that in 1988, 1 year after the worst single-day crash in history, Ronald Reagan signed an executive order creating the Working Group on Financial Markets. The Treasury Secretary, the Fed Chair, the heads of the SEC and CFTC. Its stated purpose: to enhance the integrity, efficiency, orderliness, and competitiveness of financial markets. Completely legal, completely real. No public disclosure requirement on its interventions. On trading desks, they've called it the plunge protection team for decades. Not as a joke, as a working assumption about why certain recoveries happen faster than the math should allow. May 6th, 2010. The flash crash. The Dow dropped nearly 1,000 points in minutes, close to $1 trillion gone, then recovered almost all of it within the same hour. The official explanation? One trader in London. One guy,
in a house, running an algorithm that nearly took down the global financial system for 40 minutes. I've sat with people who were on active desks that day. Not one of them fully believes that story. And these are not conspiracy people. These are professionals who spent careers inside the machine. When the people who understand the plumbing best are the most skeptical of the official explanation, file that somewhere. The official story in finance is almost never the complete story. The people who built real wealth on Wall Street learned to ask why before they asked what, because the what gets announced. The why is where the money lives. I'm in my 50s now. I've made real money and lost real money, shaken hands with people who went to prison, and had lunch with people who probably should have. Watched banks sell instruments so complicated the people selling them couldn't explain how they worked. Handed AAA ratings by agencies paid by the same banks creating them. Watched that exact arrangement nearly collapse the global economy. Then watched it rebuild with different names above the same doors. The market is not a meritocracy. The information gap is real. The speed gap is real. Dark pools are real. The timing gap I first saw on that floor in 1993 has not closed. It has gotten wider, faster, and harder to see. All of that is true, and none of it is an excuse. The one edge that has existed for 30 years that no institution can replicate, no algorithm can automate, no dark pool can front-run, is the ability to sit still when everyone around you is losing their mind. The dentist from New Jersey made the same mistake in 1999 that millions made in 2008 and 2020 and will make in the next crash. He acted on excitement going up and acted on fear going down. Both times he acted, he handed money to someone who was waiting for exactly that moment. Every single crash in S&P 500 history has been followed by a new all-time high. Every one. The people who held and did nothing, they're fine, better than fine. The people who let the headlines move their hands gave their money to whoever was calm enough to take it. 30 years, and the conclusion is the most boring sentence I know. The patient money always wins. If you want the practical side, how institutions signal their next move through futures and volume before the market opens, and how to read it without special tools, that's the next video. Watch it before you touch your portfolio this week. And if you sat through 15 minutes of this and still haven't subscribed, the button is right there. It's free. Even the dentist from New Jersey could afford it. See you in the next one.